Hello everyone. Mini Professor Olivier is back again. Are you ready for a new weekly analysis of financial markets? Oh, before I start, did you notice my new video, Billions Explained, just published this weekend? We're already over 9,000 views in just a couple of days. I'm so excited. If you enjoyed this new video explaining billions, episode by episode, please show me your support, like it, and share it. I'll be super happy to produce new episodes for you in the coming weeks. Thank you, and let's start now. We enter the final 3 months of a remarkable year in the markets, with investors counting a long list of things to worry about. The pandemic is obviously top of the agenda, but with the US election now just 6 weeks away, and the final round of Brexit negotiations underway, there is plenty to focus on away from COVID, on both sides of the Atlantic. The cocktail of concerns has hit markets in recent weeks, with the S&P 500 notching up a fourth consecutive down week, and the FTSE 100 dipping below 6,000 and staying there. This week saw a bounce back, but it followed the worst single week for 3 months, and one of the worst since the pandemic began, at the start of the year. Financials are in focus, after a sell-off last week that saw the European index of banks fall to its lowest level since the 1990s. Other sectors in the spotlight have been those most obviously at risk from renewed restrictions on movement. Travel and leisure companies, in particular, look exposed, with persistent stories that airlines are living on the edge. A wider divergence between Europe and America, where the virus is still at large, and Asia, where it looks to have been contained, is opening up. Chinese data this week showed that industrial company profits are bouncing back quickly. Although the pandemic is still top of the agenda, investors may allow themselves to be distracted in the next 3 months, when attention is bound to shift to the presidential election and Brexit, two issues which have been on the back burner over the summer. The heat was turned up in the U.S. over the weekend, by allegations that President Trump has engaged in extensive tax avoidance in recent years, to the extent that he has paid as little as $750 in federal taxes in the past couple of years. Another cloud hanging over this year's campaign is the risk of an indecisive result, possibly contested by one or other candidate. President Trump has pointedly refused to say that he will concede if he is defeated on November 3. This is playing out in the financial markets in the form of a spike in the costs of insuring against market volatility in the days around the election. Futures contracts tied to the VIX Volatility Index have spiked higher recently. Even without the usual war of words that cranks up in the weeks ahead of the four-yearly presidential vote, there are plenty of policy differences for investors to focus on in this election. The two candidates represent very different economic policies, with Joe Biden for the Democrats vowing to spend heavily on healthcare, education, infrastructure and clean energy. The Democrats have shifted sharply to left in recent years since the financial crisis. By contrast, President Trump is offering a continuation of his tax-cutting and deregulating policies, that have contributed to a strong stock market performance, and an isolationist philosophy that has divided the U.S., and set America at odds with many of its former allies. The Republicans are focusing on the Democrats' plans, attacking them as too radical. The party's agenda includes higher taxes for individuals and companies. The key, as ever, is not just the presidential election, but whether Congress swings the same way as the White House, or leaves Washington divided. A clean sweep is not always a good thing for investors, and markets can benefit from gridlock if it makes unhelpful policies harder to implement. Later this week, we will get further insight into the health of the U.S. economy as we approach Election Day. Friday is non-farm payrolls report day. Last month, U.S. employers added 1.4 million jobs, less than the 1.8 million added in July, but evidence that the economy is still recovering, if fitfully, from the spike in jobless claims caused by lockdown earlier in the year. Investors have been concerned that the rate of recovery is too slow. However, raising concerns that the pandemic will lead to a low-growth, low-inflation environment for the foreseeable future. It's the same story on this side of the Atlantic, with further evidence that the Eurozone is struggling to avoid deflation. Inflation in August fell below zero, for the first time in 4 years. The expectation is that the ECB will expand its bond buying program even further in December, and to cut interest rates even further into negative territory if inflation remains on the floor. There was some partial good news this week from the European Commission, which said that its Eurozone economic sentiment indicator had risen to its highest level since the pandemic struck the region in March. It remains below pre-pandemic levels, however, and the rise was the smallest in 5 months. The big question about Brexit in the remaining weeks of 2020 is whether or not an 11th-hour deal can be struck to avoid a hard Brexit at the end of the year. As ever with negotiations in Europe, this one is going to the wire, but in the past few days at least, the mood music has improved slightly, and investors are starting to entertain a belief, however faint, that a deal really can be done. Yesterday, the pound versus the dollar rose by more than 1%, on the back of positive Brexit speculation, coupled with some of the clearest hints yet that the Bank of England is not considering negative interest rates for the time being. Interest rate differentials between countries are one of the key drivers of currencies, and keeping UK rates above zero has been one of the explanations for why the pound has not drifted lower on pandemic and Brexit concerns. That's all for this week. I hope you found this markets update useful. Please don't forget to like it below, and you'll make my day. Thank you very much again. I hope you're going to enjoy the rest of the week, and I look forward to talking to you again next week. Goodbye.